Hello, Stephen Cruz here with mymortgagebroker.com. I wanted to take this opportunity just to review a mortgage payment calculator that I created for clients who are out shopping for a house. This is a mortgage pre-approval calculator, and so it'll give you a really good idea of how much money you could potentially qualify for based upon your income, and also it actually considers your debts. This by no means is an official pre-approval, and it doesn't replace an official pre-approval, and there are some advantages to getting a pre-approval anyway, but this is if you're just kind of in early stages, you want to kind of get an idea of what your payments are going to look like, how much you potentially could qualify for, or how much money you need to save, then this is a great calculator for you to start with. So let me just share my screen, and then we can take a look at this calculator. So I think I can move my picture down to the bottom so that you can see everything. And the web page that the calculator is on is mymortgagebroker.com/mortgage pre-approval calculator. And I will put a link in the comments below so that you can find this calculator there. You can contact me at this phone number, and this is the brokerage we are with. So mortgage pre-approval calculator is just down slightly in the middle of the page. And you can use this, again, as I said, to figure out what you qualify for. So let's say you and your spouse earn, let's say, $115,000 a year together. Now, I do talk a little bit about how to calculate your income, how much you earn. If you're on salary, it's fairly easy. It's your salary. The income that we use is your income before income taxes. So if you're an hourly employee and you make $15 an hour, 40 hours a week, then you would use $15 an hour times 40 hours times 52 weeks. $30,000 a year would be the number you use. So it's not the net you receive every 2 weeks from your paycheck. It's actually the gross income before income taxes that we use. So let's just play and say you have 5% down for now. Let's use an interest rate, say 2.64. You can use any interest rate ranging from 5.5, which is close to the bank's posted rates, which no one gets, and can go as low as 1.5. Haven't seen any interest rates as low as 1.5, but we can use something in this 2.6 range and go from there. Most first-time home buyers, most buyers take a 5-year term, but you can certainly take a shorter term, and the calculator would give you the balance at the end of the term, so you can see how much you're actually paying down on your mortgage. Mortgages are qualified at 25 years. If you choose to take a shorter term, it makes your payments bigger. It means you qualify for less. So why don't you just use 25 for now? And if you want to pay it off faster, you certainly can. Most lenders allow you to do that. Let's assume the property taxes are, let's say they're $4,000 per year. And let's say there's no condo fees. The great thing here also is you can include debts you might have. So if you have some credit card balances outstanding, some lines of credit, that sort of thing, then you can include that. What I'd want you to do is use the payment. It says balances here, but it means credit cards with balances. So just use the balances. Sorry, use the balances. So you put the credit card balances in here. I used to have it as a payment and I changed it to balances, and that's why I'm a little mixed up here, but it is balances. And the reason I use balances is because every credit card company may have a different payment, and banks have a minimum required payment to qualify. Banks use 3% of the outstanding balance. They don't use the limit. Some banks charge you 2% or 1% of the outstanding balance as the minimum payment. So I don't want you just putting the minimum payment in because it might give you a slightly skewed number. So let's say you have $12,000 in credit card and line of credit balances that you hold every single month, that it kind of stays on there, and also your loan payments or lease payments. So if you have a car lease or a car loan, you've got payments for that, then you have to put the monthly number. And so let's say you make a payment of $350 every month for your vehicle loan. So once you have these numbers in here, then you can scroll down and it'll tell you how much you actually qualify for. So on the left-hand side, there's a summary. You've shown your income in here. So your income shows over here as $9,583 a month. We put it in annual before, just shows up monthly here, just just so that you can kind of reference it to see if it's right. The property taxes, we put in 4,000 and it's 33.33 a month. The qualifying income payment, so we take your income and figure out what the qualifying mortgage payment will be. And that's not based upon the interest rate you choose, but it's actually a legislated number. It's and it changes from time to time. So the Bank of Canada, or it's actually called the OSFI, the Office of the Superintendent for Financial Institutions, determines what this interest rate is that banks have to use to qualify purchasers. And so this number represents a mortgage of $510,000. So if you have 5% down, which is what we set up here, right there, 5% down, that would mean you could qualify for a purchase price of $517,000. Now, when I say 5% down here, purchases in Canada that are above 500,000, you can put 5% down on the first 500 and then 10% on the rest. So it's not going to be a huge number, huge difference in this case because it's only $17,000 above, but it's not quite 5% of the purchase price that is your down payment. So that's why, if that number's a little off, that's why it is. So 517 is the purchase price. Your down payment is $26,750. That results in a net amount of $490,000. The insurance premium is then added on. And I've talked about default insurance in other articles in my website, but the default insurance is here to ensure that the bank gets paid back if you default on the mortgage. It's called mortgage default insurance. Originally, CMHC was the only provider, and that was a government company, a government institution. And now CMHC, Genworth, and Canadian Guarantee all offer this default insurance. The premiums are all the same. They have slightly different programs and slightly different qualification criteria, but the cost is basically the same for each of them. So when we add this net amount, so purchase price minus down payment is the net, with plus the insurance premium, that's the total mortgage. And as you can see, it's just very close to the number that you qualified for, within like 60 bucks. And your payment based upon the interest rate that you chose is actually $2,321. So it's quite a bit lower than the qualifying payment that the bank needs to use to see what you qualify for. So your payment would be, and that's the principal and interest payment, of $2,321. The property taxes were $333, and therefore your total payments for this property were $2,655. So that's kind of like rent. So if you were to rent a house, you may have utility costs and other costs, but the rent would basically be equivalent to the principal, interest, and tax payment on your house. If you had condo fees, then that would really be included in the rent normally. So your condo fees would be here too. In this case, we didn't say there was any condos. So as you can see, this last number is related to the term up here. So the term is 5 years. If you make these payments of $2,321 every single month for the next 5 years, you will end up with a mortgage of $410,000. So that means you've paid $100,000 in principal down on this mortgage over 5 years, which is actually pretty good. 60 months. That's more than $1,000 a month. If it was $1,000 a month, you would be it'd be 60,000, and it's closer to 100,000. So that's pretty good, and it's nice to be able to compare apples to apples. If you are renting a house for $2,600 a month for 5 years, it's not likely that the landlord's going to say, "Hey, thanks for renting from me. Here's $100,000." I don't see that happening very often. If it ever happens, let me know, because that would be a really nice landlord. Let's do one other calculation just so that you can see how it works. Let's say you made $85,000 between you and your spouse, and you have 5% down. We use the same 5-year term and 25-year amortization. Let's say in this case, the property taxes. The nice thing about this calculator, by the way, is that if you overestimate the property taxes based on the property, you can always reduce them later, and it readjusts all the calculations. So you can play around as you want. So let's use $2,700 as the property taxes in this case. Let's say you don't have any credit card debt. So let's say you're all paid off. Let's say you have a $600 car loan. So let's use a $600 car loan instead. So if you want to connect with me and you've been using this calculator, had some questions or whatever, certainly just fill in this contact information here, put your name, your email, and your phone number, and press the apply mortgage pre-approval. Basically, you will receive an email, and so will I, with these numbers, and then I'll connect with you, or someone from my team will connect with you and see how things look for you, answer your questions, etc. So in this case, we have $85,000 and $2,700 a year in property taxes. Your income is $7,000, almost $7,100 every month before taxes. Property taxes would be $225 a month, and that's when this number here, if you put the wrong thing in there, you can look and see if it's reasonable. Sometimes people put monthly in here, and then it's like $3 or whatever. If you thought it was $225 a month, now it's like $18. That doesn't look right. So you just go back and fix it, and then you're back. 2,700 is what I was going to say. And so you can see the numbers automatically calculate. So the qualifying payment in this case, if you earn $85,000 a year, is $2,141, and the mortgage amount that you would qualify for is $361, almost $500. So purchase price of $365, down payment of $18,293. That's a net amount of $347,579. The CMHC insurance premium, or the default insurance premium, is $13,900, and the resulting mortgage is $361,500 almost. So those are almost identical. The actual payment that you would make based upon the interest rate we chose would be $1,644 with property taxes, and that would be total payment of $1,870 a month. At the end of 5 years, the mortgage balance goes down to $291. So you're going to pay off, $70,000, something like that, over 60 months. Again, that's fantastic. A little over $1,000 a month, so you can see quite a bit of money is going towards the principal from this payment compared to renting a place. If you had more down, so let's say you had 10% down instead, so we can change this to 10%. And with 10%, this insurance premium goes down and this goes up. So that's 10% down, and that amounts $350. Insurance premium goes down, so you actually qualify for a bigger purchase price, $389. The resulting mortgage is very similar. The qualification for the mortgage is no different. So you can see the resulting mortgage is the same payments basically. Just because you have a bigger down payment, you can buy a bigger house. If you have 15% down, then again the premium changes. So if you put 15, let's do exactly 15%. The insurance premiums, or default in premiums, change every 5%. So if you have 6 or 7%, you still pay the 5% premium. If you have 11%, you still pay the 10% premium. 10%, same premium as a percentage. The premium goes to zero when you have 20% down. $413,000 purchase with 15% down. That's almost $62,000 in down payment, which results in a net mortgage of $350, and again the $361 mortgage. So your payments are the same, but the purchase price moves. So if your purchase price was moving up, this property tax is likely going to be slightly higher. Every municipality has a slightly different property tax mill rate, and so you'd have to check with your municipality to see what exactly those would be, and then you can adjust accordingly. But this is how the calculator works, and this is how you interpret the results. So hopefully you can play around with that and give yourself a good idea of what you qualify for. Let's do just one more at 20% down and see what that looks like. So if you have 20% down, you qualify for the same mortgage amount, and there is no insurance premium. Now, this calculator is really designed for what's called insurable mortgages. In Canada, there was some changes to mortgage financing over the last few years, and now mortgages can either be insurable or non-insurable. And so if your mortgage is insurable, that means that the lender can have the mortgage insured after it's set up. So a lender may set this mortgage up and then pay for the default insurance so that they're protected. They won't charge you the premium, but they will pay a premium to do this. And there are some requirements for that. One of the requirements is that the maximum amortization is 25 years. You could theoretically qualify for a mortgage with 20% down and use a 30-year amortization. I have not done that in this calculator, and it's just too complicated to explain how all that works. So this is basically for insurable mortgages only. If you do have 20% down or more and you want to have a lower payment potentially amortized over 30 years, then connect with us and we can work out those numbers for you and let you know exactly how that looks. But this gives you a very good idea of what you would qualify for, and very close to what you would qualify for. The payment's going to be a little lower with a 30-year amortization, and so therefore you're going to potentially qualify for a bigger purchase price. Anyway, this is the calculator. I hope that this is helpful to you so that you can use it yourself and figure out some numbers, and then again connect with us and let's see what you qualify for, get you an official pre-approval when you're ready. Thank you again, and have a great day.